Hello everyone, and welcome back to Accounting 101 with me, Galvin. So today we're going to talk about year-end adjustments in income statements. So year-end adjustments are adjustments made to incomes and expenses on the income statement. They are either paid or unpaid. So when it comes to year-end adjustments, we're going to apply them to the incomes or the operating expenses parts of the income statement. So we have a question. The trial balance relates to general enterprises as at 31st December 2020. So for this question, our year-end adjustments are going to be stock at 31st of the 12th month 2020, 12M, salaries due 5 million, prepaid rent 500,000, telephone bill owing 22,000, and provision for bad debts adjusted to 10% of debtors, depreciation, furniture, and machinery. So this is our trial balance, and we are going to use this to work out an income statement and apply these year-end adjustments to the operating expenses and the incomes, the area for operating expenses and the incomes. So if we work this out correctly, you're going to notice that for the area of operating expenses and incomes, there is going to be a few calculations we're going to work with. So let's get started. So as I said earlier on, for any financial document, for this case an income statement, we start off with the title or the name of the business. So General Enterprises income statement, then we write the name of the document, income statement, for the year ended 31st December 2020. So this is the business name, the document name, and the accounting period for which we are preparing this accounting statement. So we have our question. So if you remember correctly what we did in the previous session, we said that an income statement has 4 columns. The very first column is for details, the next will be for shillings, the third one will also be for shillings, and the last will be for shillings. So let me adjust the camera a little bit so that you can see properly what I am writing. Let me see. Yeah, that's it. So let me roll this real quick. Okay, so let's move on. So moving on, so the very first part of an income statement, if you remember correctly what I told you before, so we start off by writing the sales. So in our question, our sales are valued at 40 million shillings. So we're going to put there 40 million shillings. So now to get the net sales, we're going to less sales returns. We're going to subtract the sales that we brought back. When a business sells something and a customer brings it back, that becomes sales returns. So right now our sales returns are valued at 500 Ugandan shillings. So we are going to put here 500 Ugandan shillings. So once we subtract these two, we get net sales. So our net sales, if you calculate this correctly, let me see, it should give us around 39,500,000. So let me draw this line and then I calculate that totaling to, let me see, yeah, that should give us 39,500,000. Do not forget this, at this point of an income statement, your calculator should be really close because you're going to calculate a lot of values. So now we have our net sales. So now we must subtract the cost of sales to get the gross profit. So our next title is less cost of sales. We underline that. So to get cost of sales, we're going to first ascertain our opening stock. So our opening stock is valued at 10 million Ugandan shillings. And then we're going to add our net purchases to this. So net purchases is equal to purchases, which is valued at 30 millions. So purchases is valued at 30M less purchase returns. So when you buy something and take it back, that is purchase returns. So this is valued at 620,000. Oh, sorry. I wrote that in the wrong column. Let me fix that a little bit. So the 30 million is supposed to be in the first column since we're going to calculate it. And then even the purchase returns is supposed to be in that column since it is let me cross this real quick. So we are going to first calculate this first column of shillings so that we can find the net purchases. Then we shall write the net purchases in the next column. So after that, we are going to subtract purchases less purchase return. This should give us 29,380,000 shillings. So those are our net purchases. So if you add opening stock plus net purchases, it should give us cost of goods available for sale. So once you add those two, you're going to get around 39,380,000 Ugandan shillings. So that is our cost of goods available for sale. So 39,380,000 shillings. So as to find the total cost of sales, we're going to less closing stock. So our closing stock is the stock in the business that we have at the end of a given trading period. So that is 12 million. So once you subtract that, then you have the cost of goods available for sale. So if you calculate that, our cost of goods available for sale should be 27,380,000, as you can see. So let me underline that real quick. So now we can properly obtain our gross profit. So our next is to find gross profit. So the gross profit is going to be there, and this is going to be valued at 12,120,000. So that is our gross profit, everybody. So congrats, we've just finished finding gross profit. Now we're going to move on the part that this video is mostly about, the year-end adjustments. So we are going to write the next title, which is add other incomes. So these other incomes, the very first other income is depreciation. No, sorry, it is provision for bad debts. So it says that provision for bad debts is adjusted to 10% of debtors. So you're going to look at your income statement and then calculate 10% of debtors. Then you'll have to go ahead and subtract to see the difference between the new provision for bad debts and the old provision for bad debts. So if the provision increases, that is an expense. If the provision decreases, that is an income. So right now we have a decrease in provision for bad debts. So once provision decreased, it became 702,000 shillings. So that is our provision. So those are all the incomes we have in this income statement. So our total incomes are 702,000 shillings. If you would like more information on provision for bad debts, please comment provision for bad debts so that I can get you that information. But now we can find our net income since we have total incomes. So to find net income, we said we add total incomes plus gross profit. This gives us the net income of our business. So our net income is valued at 12,822,000 shillings. So we move on to the operating expenses. We are lessing operating expenses as our next title. So the very first operating expense is salaries and wages. So if we look at our year-end adjustments, we can see that salaries and wages has a year-end adjustment that says salaries due at shillings 5 million. So right now from the income statement, it says salaries and wages are valued at 3 million Ugandan shillings. So since we're calculating that, we're going to write that in the very first column. So that is 3 million Ugandan shillings. So now, since these salaries are due, which means they are not yet paid, so we are going to add salaries due. So 3 million plus 5 million. So this should give us salaries valuing to 8 million. So our next operating expense is rent. If you look at your income statement, at our income statement, the rent is valued at 600,000. And then once you look at the year-end adjustments that I gave before, it says prepaid rent is valued at 50,000 shillings. So this rent was paid before it was prepaid. So we're going to less prepaid rent. So once you subtract that, you're going to have 550,000 shillings as our rent. So our prepaid rent is 500 is 50,000, the rent which was paid before. So once we subtract that, the rent we paid before, we come down to 550,000 as our total rent. So these are year-end adjustments. So our next year-end adjustment is telephone bill. So our telephone bill from the income statement is valued at 100,000 shillings. So once you have that, you go and check your year-end adjustments for where telephone bills are. So it says telephone bill owing 22,000. So we are being demanded telephone bills of 22,000 is owing. So we are going to add telephone bill owing. So our telephone bill owing is 22,000 shillings. So we add that. So once we add that, we're going to have 122,000 shillings as the total value for telephone bill. So now we're going to add provision for bad debts. Since it's also an operating expense, it's an expense the business meets as it carries out its daily transaction. So our provision for bad debts from our income statement is 98,000 shillings. So our next operating expense is bad debts. So our bad debts are valued at 20,000 shillings. So as you can see, our year-end adjustments are almost done. So the very last year-end adjustment is depreciation. So depreciation, our year-end adjustment says depreciate furniture at 10% and machinery at 10% per annum. So furniture, once you multiply 10% of the value of furniture, which is 4 million, our furniture would cost 400. And once you multiply machinery times the depreciation, that is 600 million. So depreciation is the loss in value, and depreciation is recorded as year-end adjustments. So once you add all of this, our total operating expenses are equal to 9,790,000. So with this, we can move on and find our net profit. So our net profit is got by subtracting our net income minus total operating expenses, which is 12,822,000 minus 9,790,000. So this should give us 3,032,000. So the total of the operating expenses is 9,790,000. So once we are to get the net profit, we are going to subtract 12,822,000 minus 9,790,000. This should give us our net profit of 3,032,000. So that is how you work with year-end adjustments when it comes to income statements. So thank you for watching, and let's meet again.